You've built a highly profitable, rapidly scaling California service business. But when it comes time to sell, there is a distinct pattern. What starts as a massive payday routinely collapses during institutional due diligence. A deal begins with a letter of intent offering a headline enterprise value of $6 million. Over 90 days of diligence, that valuation is chipped away by price adjustments and deductions until aggressive risk mitigation tactics lock what remains in an escrow holdback. If you sell a manufacturing plant, a buyer can touch the CNC machines, walk the real estate, and physically count the inventory. Service firms are asset light. Your most valuable assets walk out the front door at 5 o'clock. Institutional buyers prioritize operational proof over physical assets. They demand a business that functions independently of its founder. They lower the price because the founders cannot empirically prove the business will keep running when they step away. The operations live entirely in the founder's head. Earning a 5x to 7x multiple requires translating founder intuition and client relationships into verifiable, risk-adjusted systems that survive the transition. The first major point of friction in these deals comes down to how you measure profit. Most Main Street brokers price businesses using SDE, or seller's discretionary earnings, while institutional buyers strictly underwrite Adjusted EBITDA. SDE measures the total income a single owner-operator can extract from the business. Adjusted EBITDA measures the durable cash flow available to an acquiring institution after operations are fully staffed by a dedicated team. This chart shows how buyers translate one metric to the other through a quality of earnings bridge. It starts with your baseline book profit, say $700,000, and normalizes it to reflect your actual run rate operations. First, we apply standard add-backs. We increase the baseline valuation by adding back non-recurring costs like one-time legal expenses, alongside clearly documented personal items. But here's the critical nuance many service founders miss. Private equity buyers will always price in the cost to replace you. If you currently act as the lead salesperson and delivery manager, the buyer has to hire a general manager to do that work. They will mathematically subtract that market rate salary directly from your earnings. What remains is your Adjusted EBITDA. This is the foundational valuation metric that will actually survive institutional diligence. If the firm's revenue is entirely dependent on your personal network to close deals, the buyer will model out further financial deductions to hire a dedicated sales and operations team. Contrast that with a firm that already has documented systems and a secondary layer of leadership in place. Buyers will eagerly pay a higher multiple on the exact same baseline earnings. An institutional acquisition is an investment in durable cash flow. This means the multiple is tied directly to the quality of the independent management layer. Premium buyers run an informal, highly revealing test during diligence. They interview your key clients and simply ask who actually executes the work. If your top clients indicate they only ever deal directly with you, the founder, the buyer immediately penalizes the deal with severe price drops or heavy holdback protections. Often, they just walk away. To prevent this multiple discount, you have to build an architecture of transferable value. This requires constructing 3 distinct pillars. First is contractual certainty. A buyer cannot underwrite good relationships if they only exist as handshakes. Loose monthly retainers must be replaced with strict assignment language that survives a change of control, structured renewal mechanics, and clear service-level agreements. The second requirement is operational autonomy. This means building a team capable of scoping a project, pricing the work accurately, and recovering margin without requiring your daily oversight. Finally, you must deploy structural intellectual property. You have to get the company's methodology out of the employees' heads and into a permanent system. This requires comprehensive standard operating procedure libraries, documented delivery frameworks with strict quality gates, and standardized training paths for new hires. When a firm meticulously documents its methodology, it ceases to sell arbitrary hours. It successfully transforms into a highly valued platform. Once the earnings multiple is locked, the negotiation shifts to the quietest, most mechanical battleground where buyers alter seller proceeds, the balance sheet. Most transactions are structured as cash-free, debt-free deals. However, the seller is still required to leave enough operating liquidity behind for the business to function on day one. This chart tracks accounts receivable across 24 months, showing the clear wave-like peaks and valleys typical of service sector billing cycles. Buyers capture this liquidity requirement using a net working capital peg. In this example, the parties agree to a rigid target of $350,000. The hidden danger is that this peg functions as a stealth price adjustment mechanism at closing. Look at what happens if the closing date lands in a seasonal trough, where your actual working capital dips to $250,000. Because you are $100,000 short of the peg, the buyer will levy an exact $100,000 financial penalty against your final proceeds. Buyers will also opportunistically define what specific liabilities and assets are actually included in the working capital basket after the initial agreement is signed. To defend against this, you must normalize the peg using 12 to 24 months of historical data, accounting directly for the inherent seasonality of your service billing. Failing to mathematically define this peg ensures a founder can sell their business while unknowingly abandoning 6 figures of hard-earned equity at the closing table. There is a final layer of diligence friction unique to the local operating environment, particularly for firms headquartered in California. Buyers heavily underwrite 2 specific state-level risks: worker classification and wage and hour compliance. The state's classification framework applies the ABC test, presuming a worker is an employee unless the company can clear 3 specific criteria. The worker must have autonomy, perform tasks outside the usual course of the company's business, and be engaged in a customary independent trade. Failing any of these immediately opens the firm to severe exposure under PAGA. This is a critical issue for founders who rely heavily on independent contractors to execute their core delivery tasks. Furthermore, poor record-keeping regarding meal breaks, flawed overtime calculations, and expense reimbursements creates highly repeatable risk vectors for class action litigation. Buyers weaponize these compliance gaps. They demand heavy escrow holdbacks to insulate themselves from any post-close legal actions. Auditing and documenting your compliance posture long before going to market is the only way to prevent surprise diligence findings from becoming a buyer's ultimate price leverage. This brings us back to the core paradox of why so many promising service firm deals collapse at the finish line. When a firm prepares correctly, the initial $6 million offer remains intact, the quality of earnings is verified, the working capital peg is defended, and the regulatory exposure is immunized. Premium valuations are never granted based on raw top-line revenue, tax basis accounting, or a founder's sheer charisma. The solution requires aggressively systemizing your operational IP, mathematically defending your historical capital needs, and rigorously auditing your state compliance. In the lower middle market, the final price is a reflection of the engineered systems that make intangible value transferable. That is the core of the transaction.